right now. Suyog Kotecha, the CEO and ED at Aarti Industries here on the show. Suyog, good to have you on the show. We were just going through your numbers. Morning. Weak set of numbers, right? For a second straight quarter. Tell me, what are the reasons which are weighing down, and where do you actually see pain regarding, your logistical issues, and if they will continue in the next quarter?
Yeah. Quarter one was indeed tough. Quarter four was quite decent. I think in Q1 we struggled, especially in the third month of the quarter, broadly driven by two aspects. One, I think the Israel-Iran war really had huge impact in terms of shipment schedules, which led to a lot of bulk shipments getting pushed out to the month of July. That was a dominant factor in the month of June. And the second big one was actually raw material price correction. The two major raw materials that we use, benzene and aniline, corrected by almost 15 to 20% on a quarter-on-quarter basis. And that was one of the primary reasons where we also took almost 30 crore out of inventory valuation loss. Those two major reasons for Q1. I think part of it, which was deferment of shipments, is expected to recover in the quarter two.
Right. Okay. What about margins? Because they've also taken a dip and it's now sub 13%, right? Tell me a little bit more about the pricing trends, and will we see a rebound in margins in the coming quarters?
So I think the margins, honestly, are expected to remain at this level. I think the pricing pressure remains quite intense, driven by competition from China and rest of the world. So we don't expect a significant recovery in margin. They're expected to stabilize at the current levels. So most of the growth is expected to come from volumes than margin for the subsequent financial year. The overall sense that we have is the global overcapacity situation across multiple value chains in chemical industry is expected to take at least 1 or 2 years before the situation stabilizes, where we see meaningful margin recovery.
Good morning. Also help us understand what is your exposure to the American markets in terms of exports. What kind of impact is expected on the company after the US has imposed its most recent tariffs? At least that's what the announcement is. And help us understand what percentage of your product mix will be affected.
So roughly, on an average, our US exposure is 15 to 20% of revenue. Last year, to be precise, was 18% of revenue came from North America. In quarter one, it was in the range of 16%. There are broadly three set of products that we see different trends in terms of impact on that business. One is which is sort of exempted from the tariff. So I think that portion of the business is relatively sort of safe. The second category of the products is where we end up competing either with Europe or China. I think there it's a matter of what is the ultimate relative tariff differential, and in that context we will end up competing to retain the share. I think the third one is where it's sort of in a market development phase, where the consumer affordability in US itself will become questionable with 25% tariff. That's where I think the impact is expected to be significant. But as we speak, we are, we continue to sort of remain in the evaluation phase. We don't know exactly where it will settle, but the impact will differ from product portfolio to product portfolio.
That's the take on your US exposure, but also in terms of your capex plans for FY26, help us understand what these plans are, how are they shaping up, and we've also read some brokerage notes. They expect meaningful ramp up of capacities in the second half of FY27. Could you help us understand a little bit more on that front too?
So on capex, we remain on track. I think last year we had given the guidance of roughly 1,000 odd crore capex for this year, and we will continue to maintain that guidance. I think roughly we did around 270 to 80 odd crore of capex in the first quarter. So we are on track to hit sort of slightly below 1,000 crore kind of number from a capex point of view. And as you rightly mentioned, we are expecting this capex to gradually commission towards the second half of this year. Bulk of the volume expansion will also come from capacity where expansion is already complete. I think we announced ethylation and nitrotoluene capacity expansions last year. I think they are in a ramp-up mode. I think on the energy MMA product, we announced capacity expansion from 200 to 260 KTPA. That will also ramp up gradually over the course of next few quarters. And in addition to that, especially one particular value chain, DCB, where we had relatively lower utilization levels in the first quarter, there also we are expecting volume recovery to pick up in the second half of the year.
So you've spoken about electronics rather. You've spoken about chemicals, defense, advanced polymers in your annual report as target industries for future growth. Any timeline, anything specific that you could tell us? Capex, strategic outlook, why these sectors?
No, so I think overall, as we try to improve the margin profile of the business, we have to look at end markets which allow us to play in that margin profile. And all the sectors that you mentioned are kind of priority sectors where we see not only long-term tailwind from a demand growth point of view, but also relatively robust margin profiles, which is defendable over a medium to long term. And that's why they are in focus areas. At this point in time, what we are building in one of our greenfield zone 4 is kind of a multi-purpose capacity. So it's not a dedicated chemistry capacity. So depending on how the business development effort ramps up on many of these end markets, we should be able to utilize that asset which is already in a build phase to manufacture many of these chemicals. So, you can roughly anticipate that multi-purpose facility will start around second half of this year. And sometime in the next financial year is when we should sort of start seeing first molecules hitting into this particular end markets.
Okay, and so segmentally, if we now focus on agrochemicals, volume recovery here is visible. However, pricing pressure still remains, as stated in your con call too. Could you help us understand what would be a suggested timeline in terms of when we can see a recovery here?
So as I said, volume is visible, margins, our sense is still will take time. I think the first players who will see the margin recovery will be the downstream, which is our customer, which are more closer to farmers. And I think if I look at the set of numbers, some of them have started to see margin recovery. So that should ideally flow to the intermediate suppliers like us over the course of, next few months and quarters. But if you look at the macro situation, I think the overcapacity situation in China is not yet resolved. So in that context, as I say, that you might see, few quarters of slight bump up in margins from some of the AgChem intermediates point of view. But a long-term margin recovery to go back to the historical levels, we feel it will take some time, till the overall demand-supply balance situation is corrected in the global market.
Sure, okay. And before we let you go, also give us a sense on where the debt is right now on the books. We understand the debt levels are slightly risen, but the management is expecting reduction of 200 to 300 crores in FY26. Could you help us understand what could be the levers at play here?
No, so I think it's gone up in Q1 slightly, also driven by the working capital increase as a lot of bulk shipments got deferred from June to July. Overall, we are expecting it to remain at the last year level, plus minus 200 crore is depending on how the business pans out. But broadly, the target is, despite 1,000 crore of capex, retain debt at sort of closer to last year's level.
So good to chat with you, and we'll speak again soon.
Thank you.
That's Aarti Industries for you, hopeful of a turnaround in the next few quarters.